I just wonder how much is priced in already, how much upside there is as a result of these rates. I mean, you're going to try and balance it, of course, with the idea that, the economy may really actually be in a very bad spot.
Yeah, so the immediate reaction was positive. It was a positive surprise, but then the market, this was back on Wednesday, and then the market faded a little bit. But then the next day, everyone got excited again, and we had an up 2% day in the S&P, and today we backed off that a bit. Look, rate cuts are positive for asset prices across the board, right? They're positive for stock valuations. Gold has responded positively.
Yeah, I'm just looking at gold today, up 1.25%, $2,647 an ounce right now on gold.
Yeah, and the thing people should recognize with gold is that it's kind of competing with interest rates. When interest rates are high, investors preference for putting their money in the bank, earning interest. Interest rates are high. As they come down, there's less of that opportunity cost. So gold really benefits from lower rates. As do stocks. Because we have a lower cost of capital, and it's cheaper for companies to borrow.
I just put the gold NYMEX up price per ounce right now, just so people could see that there. NYMEX near term versus its peers. Walk us through this chart. It goes back to, it looks like 22.
Yeah, that's a 2-year chart on gold, and you can see the most recent leg up very, very recently, just with the rate cut. But a lot of this has been anticipated. So really over the past month, gold has performed quite well, really because people were anticipating, and the market generally was anticipating rate cuts, especially with those jobs numbers coming in light and the revisions. But over the past 2 years, the story of gold has really been basically an upward trajectory. A lot of different recently, the interest rate outlook.
Yeah, no, it's a lot of different things, and we've talked about this. I encourage people to explore the channel here at 76 Research. Also, make sure you subscribe, share, like, comment, all that good stuff. We are live right now on YouTube, but we do have some content that deals specifically with gold, because there's a lot of reasons, and we won't get into all of it at this particular moment, but I do encourage people to explore, because whether you're thinking about what's going on around the world, and you have all these sovereigns, other countries basically saying, ooh, maybe I don't want to be so reliant on the US dollar. And so one of their diversification tools is to get out of treasuries, to get out of dollars, and to go into gold. And so that's part of the reason for the upside. You also have just the reality, unfortunately, of this never-ending debt crisis that we are in right now. And I think that all of that sort of catches up with things. And, we've written on this quite extensively. I'm just putting the website up there, 76research.com. You can go there. You can get our newsletter. You can use code word dollar for the newsletter when you go to checkout, so that you get it for $1 a month for the first 2 months, $9.95 thereafter. But again, there's a wealth of information there in the archive. On the YouTube channel, of course, for free. You get free stuff if you go and sign up there on the website as well. But the key is to get the 76 report and to get, hopefully, some of the portfolios. We'll get into that in just a moment. But gold is one of those things that, yes, is seeing this upside right now. I would anticipate, look, Rob, you know this about me, right? Like I joke that I really, I'll feel nervous before I need to feel nervous sometimes. I don't feel that. I mean, other than maybe Kamala Harris winning and taxes going through the roof. I don't feel that nervous about the general economic climate in the sort of here and now, in part because I'm so convinced of the technology play. And so when I think back to other times when we've had struggles, and I think about the mortgage crisis that led us into 2008, the subprime debt crisis. I mean, I was going on about that in 2005, right? I was panicking about that long before I needed to be that worried about it. I was really worried about the dot-com bubble back in 98. And sure enough, it hit in 2000. So right now I'm looking and I'm like, okay, the Fed's worried. Normally I'm the one that's worried. So I hope it's not a political move. I don't want to dare say that that's in fact what is motivating things. I think if they wanted to make it a political move, they should have done it earlier. It's a little late at this point, given that these things take time to work their way through the economy. But the thinking, and just as a primer, and walk us through it, is that people will have more access to capital. Theoretically, businesses should have more access to capital because rates are coming down. Therefore, you can borrow more cheaply, and thus more people are expected to borrow, thereby driving this engine of growth, which is, based on borrowing, whether we like it or not.
And that's how, the logic works in terms of interest rate manipulations to kind of spur the economy or slow it down. I think, what really has been happening, and the way that perhaps Powell framed it, is the point of getting interest rates, the Fed funds rate, to such high levels has been to kind of to suffocate the economy. We've had this inflationary burst, as he put it, which I thought was kind of an interesting description. We went from transitory to burst, which I guess lasted longer, a couple of years. And now they're getting evidence that it's really damaging the consumer, and we see
you think?
It's not just the jobs, but it's credit card delinquencies, and there's other indications that the consumer is really suffering. So I see it as kind of like a bit of a divide between like new economy, old economy, like we talked about 25 years ago, during the tech bubble. Regular people, everyday people, traditional industries, people are suffering under the weight of high prices and high interest rates. But separately, when you look at the tech economy, I don't see any weakness there, and I don't think the Fed's signaling at all any weakness there. This is more about the broad consumer economy suffering under the weight of a very high interest rate environment. And to be fair, rates have been quite high, and they have a lot of wood to chop. If we are getting to the point where the economy is potentially in a perilous situation, you're coming from 5.25, and what people tend to think of a neutral rate is 2.5 to 3. So